Hello and welcome to Morningstar. I'm Emma Wall, and joining me today to give his 3 stock picks is Freddie Lait, manager of the Latitude Horizon fund. Hi Freddie.
Hello.
So what's the first stock you'd like to highlight today?
So all 3 stocks that I want to talk about are very, very cheap stocks in the current market, which is characterised by overvaluation, and all 3 have a digital angle, which I think gives them a great reason to own them for the next year or two and on for the next 5 years. The first stock is Bank of America, one of the leading banks in America. It's a universal bank, so it has trading, markets business, investment banking, and a retail business across America. It's trading on 10 times earnings, 1.5 times book value, which historically have been more like 14 times earnings and 2 times book value. So I believe it's trading 30 to 40% cheap in any event, plus there's a couple of key reasons to look at it. One is that growth in America is coming through very strongly. Loan growth is set to be 5 to 10% a year for the next few years. And critically, the growth over the last decade since the crisis has been an incredibly high quality mortgages, high quality corporate loans. So I believe the balance sheet is far stronger, the business is far better capitalized, and it should experience some great growth. There's going to be some even better operating leverage driving through to the bottom line because of digitalisation. And the 3 key areas for them are payments technology, trading systems, and customer satisfaction and service. If they can interact with you through their mobile banking app, it costs them 1/10 as what it costs them to deal with you in branch or elsewhere. So I see reason to believe that they could cut 10 to 15% out of their cost base, driving earnings a further 30% higher. So I think you could make 75% or maybe even 100% out of this stock over the next 3 to 5 years, and you're getting 6 to 7% capital returns through buybacks and dividends already.
Pretty good. And what's the second stock today?
So the second stock is probably a little bit more contentious. It's Royal Mail, which we in the UK obviously know, but in case you have global listeners, it is the universal service operator for delivery in the UK. But critically, it's also got a very, very successful international business called GLS. Now, the overall business trades on 10 times earnings, again, very, very cheap. But GLS is 1/3 of its operating profit, growing at 10% a year, very high margin, incredibly well regarded. And if you exclude that from the 10 times, actually the core business in the UK trades on around 7 times earnings, which I believe is incredibly cheap for a business with this market position. Now, they've come out of a position of very heavy unionisation, very heavy pension deficit, and they have a lot to do with their balance sheet to fix it, but they've done most of the things they need to do. Their productivity's been improving dramatically, and their gross hours worked has gone down 15% while driving increased revenues and margins, which I think is a phenomenal achievement over the last 5 years. They have one of the top 5 brands in the UK. They continue to monetize that. And critically, this digital angle, if they can get tracking onto your parcels and letters, which they're getting that market share up far higher, it's 50 to 75% cheaper to do the delivery for them. Not to mention the obvious thing about the fact that digital is driving us all to shop online more, and that's driving parcel volume, as well as advertising it in post. And then once again, the customer interface that they can benefit from if they send you a text and get you there on the hour, et cetera, and the deliveries aren't missed. It's a phenomenal pickup in potential margin for this business. It pays a 6% dividend, and I think there's a lot of reasons to be hopeful for the next 5 years that they can double their margins.
And what about the third and final stock?
So the third and final stock is a European stock. It's Orange, which is the old France Telecom. It is fixed and wireless in France. It's trading a little bit more expensive. It's on 13 times earnings, but for a very, very recurring earnings base, I still believe that's very, very cheap. It has a 5% dividend and a phenomenal position in its cycle where, post the dot-com bubble in 2000, it's undergone this massive transformation where the regulators have been aggressively attacking the market and have now taken their foot off the throttle a little bit. So I think the regulatory cycle is turning slightly in their favour. And again, the key thing for them is this cost saving, which I believe is a 30% cost saving, a potential market share from moving from manual services to digital. For example, they recently relaunched their app using IBM's AI software, Watson, which is obviously a very advanced digital software, and it's cut their calls in half by 20% in half a year, which is a phenomenal achievement. And again, it's about 1/10 as expensive to service someone through an app as it is through personal interaction. Their revenues are also driving through digital as they cross-sell and manage to target banking customers from their telco base. And I just think that's a phenomenal thing for their cash flow. And I think probably a 30% incremental uplift for their cash flow over the next 5 years.
Freddie, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.